Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us Enrico Brex, who's a financial advisor with Elite Retirement Consultants. Enrico, welcome to the program.
Thanks for having me, Mike. It's good to be here.
Yeah, you're welcome. I want to learn all about what you do to serve your clients, but I always love hearing the backstory of what gets someone in the industry that they're in. So were you one of those third graders that stands up and goes, one day I want to be a financial advisor? Or was it, doctor, lawyer, fireman? So what got you into the financial services industry in the first place?
The story goes back a little bit. I was working in manufacturing for a number of years, and that fizzled out for one reason or another. And I met a guy through youth football where he got me into insurance. He had a small brokerage firm, and he was nice enough to take me under his wing and start learning about insurance. But he wanted to go the route of a call center. And I wasn't really interested in that. And I started to get referrals from a neighbor of mine who has a financial services firm. And what started to get me more interested in insurance is how the different types of insurance products were placed to complement retirement plans.
Yeah. Well, it's interesting you say that because it makes me think of something when you think about call center and calls. That's very, nothing wrong with that, but Matt is very matter of fact. It's very stoic. It's very cold in a sense. And I would feel that relationships result in referrals. And you said, you get referrals. And so it tells me that you work toward building relationships with people and your curiosity of, we don't just use this life insurance product as death benefit. There's some real powerful creative ways to use it. So before we kind of talk about how you serve your clients, talk a little bit about how you develop relationships with your clients.
Well, a lot of the clients that I work with most of them come from a book of business that we already have here at our firm, which is quite large. And during the quarterly reviews, there's always different changes in people's lives, retirement, pre-retirement, where the insurance conversation comes up, and then it goes from there.
Yeah, you mentioned briefly, and this right here is how insurance factors into a retirement plan.
We go right back to that now.
Yeah, because, it's interesting. I think a lot of people go, insurance, that's like what happens when you die and money goes to your family. But you're talking about this is a factor in a retirement plan. That's before retirement. That's to prepare you for retirement. So how is life insurance, actually a piece of the puzzle?
Well, where it becomes a real important piece to the puzzle, besides death benefit, is how we take advantage of living benefits in some of these different types of policies. And it's really become a powerful tool for us and our clients.
So I love the sound of a living benefit, because anytime you get a benefit, that's a good thing. But what are some of the examples of how you would experience living benefits with life insurance?
One of the living benefits that we like is how we could use cash out of permanent life insurance to use for our clients, their children's college, other business ventures, things like that. That's a really powerful tool. And one of the ways that we implemented is for long-term care. A lot of the long-term care riders that come along with these policies are what it does is it gives the client a fixed cost, a predictable cost.
So talk a little bit about cash value, because again, from a newbie hearing the word life insurance, I think of a 20-year term, and if you pass away, then whatever the dollar amount goes to your family. But now you're talking about permanent, and you're talking about cash value. So how does cash accumulate in a policy like that?
Well, To keep it simple, what happens with the cash value is, let's say a mutual company will pay interest, that's a contractual interest rate to the policy. And as you pay your premiums, the cost of insurance is paid for, and that extra monetary value will go towards cash.
So literally, it becomes almost like a investment account
Correct.
that
Yeah,
has, death benefit too, but, it's not just some dramatically huge death benefit. It's a ample death benefit, but as you're structuring the premiums and paying them, a portion, kind of like in a mortgage, some of it goes to pay interest, some goes toward principal. Well, in this scenario, if I'm hearing you correctly, some of your monthly insurance premium pays the actual death benefit, but then some of it goes toward your cash value and it builds up. And then now that is what you can, use for some of these living benefits you're talking about.
right. It's funny you mentioned the whole term thing. I can't tell you how many times I've had that conversation trying to discuss some of the useful aspects of permanent coverage, and it goes back to that term. Well, what do you mean? All insurance is just term insurance, isn't it? I'm like,
Yeah.
oh, wow.
Well, and here's something else. And again, you're the professional, I'm not. But isn't it sort of like I mentioned the example a second ago about mortgage, some goes to principal and interest. So let's use the same real estate example. Wouldn't term insurance be kind of like renting, where when you move from that unit that you're renting, you don't have any equity build up. But if you have a house, you have a mortgage. Well, if you move, you're getting tax benefits for the mortgage payment. And when you move, maybe the house has gone up in value and you make a profit. Well, in this scenario, like term, when the term's ended, it's gone. You don't have any value. But in a permanent policy, maybe there's some cash accumulation. Maybe there's some guarantees. Maybe there's some, you're getting a lot of benefit. And it's kind of a neat correlation to think of it like renting versus buying, right?
Right, exactly. Actually, that's a great way of putting it, Mike. I'm going to use that next time.
Oh, you can steal it.
The
You
house
got it.
rental.
Right. That's a good point. Well, also, let's talk about something. When you think about retirement, you think about planning for retirement and investing, and then the big R word comes to my mind, risk. So when you think about now this product, this, tool, permanent life insurance, if you're putting money in and you're seeing the cash value accumulating, what are some of the risks? Or are there risks? Can the cash value plummet and now I'm losing money, or what does that look like for the client?
Yeah, depending on the type of permanent insurance that you're building cash value in, sometimes if the premiums could go up if the performance of the certain policy is not keeping up.
Sure. But that's not like, wow, my portfolio was 100,000 and the Dow Jones plummeted, so now my portfolio is 82,000. Wow, I lost a bunch of money.
Right. If the insurance you're talking about is going to be an IUL, which is an index universal life policy, they kind of are going to work in the same way as annuity would, in the sense where you would have a floor.
Yes.
So you wouldn't have any participation, but you would get zero.
Right. Like
And
your
that
buddies might go, woe is me, my portfolio plummeted and I lost a bunch of money. And you go, oh, well, I didn't gain anything, but I did not lose it. So that floor is a really great protection.
Correct. Yep.
So talk a little bit about cash value and how then that grows. So yes, as you pay premiums, it grows that way, but talk a little bit about the growth. Is there rates of return you can, expect, or what about, I hear about dividends you can get. So there's some multiple ways that you can be seeing your money grow, right?
Right. So some of the mutual whole life companies will give you a annual dividend if you select to receive it in cash in a given year. Some of the bigger mutual companies have been paying dividends, I guess, from the 1900s. They say the dividends are not guaranteed, but they've been around a long time, and I think they're going to continue to pay annual dividends.
Yeah, it might not be literally guaranteed, but if there's that track record of decades and decades, it's probably going to be expected. But also, is there an aspect of a rate of return that's guaranteed? So we talked about you can't lose money, so there's a floor. Is there a rate of return that you could go, okay, when you've got this much cash in the policy, you're guaranteed a return of X?
Well, with regard to whole life, at the time the policy is issued, there's a contractual value of a percentage that you're going to receive. Well, the insured is going to receive whatever it is, 2 or 3%. In the case of IUL, the percentages will depend on the selections of the separate account that you choose.
What it's
if
tied
you
to,
select
the index that is tied to.
Correct.
Yeah.
Yes.
But is there still a guaranteed rate of return, like 2, 3, 4%, something like that? And then it could be more depending on what the index did?
Correct. Yes. So even in the IULs, you could select the guaranteed rate.
Yeah.
You could select your entire account in the guaranteed rate, but you're not going to be able to participate in any of the markets that they
In the huge
have
upside.
available.
Right.
Right.
But if I'm kind of the one going, now, am I right here? So there's a floor. You can't lose your money. And then there is a guaranteed rate of whatever that it's going to be, depending on the type of policy that it is. So you can know that you're going to be guaranteed a return of X, whatever that is, 2, 3, 4, 5%. But that's sure a whole lot better than a lot of other accounts that can't give you a guarantee, and you might lose money depending on what the fund does. So far, this is like, okay, it's not term, it's permanent, and it gives you some rates of return that are guaranteed, and you can't lose money. Where's that sounds wonderful.
Yeah, it is. It's definitely a good function, and again, with the IULs, you can choose the guaranteed rate, or you can choose a combination of the market and the guaranteed rate. And you could change that annually in most cases.
So kind of like an annuity where you could go in and go, okay, I want half my portfolio or amount in this annuity to be in, guaranteed of X number of percent. And then I want the other half to be in this little mix of funds. So the same thing here, if this is a IUL, you could say, I want half of it to be guaranteed at whatever the rate is. And then the other half, let's participate to see if there's some upside. You're still not going to lose money, but there still could be some upside where it could potentially be a little bit even higher than the guaranteed rate because you're participating in something that could go up.
Right.
That's curious. So you mentioned something interesting too, college tuition. So let's get back to living benefit. So I'm putting money into this safe, protected, proven, vehicle, permanent life insurance, but oops, I put a bunch of cash in there and now the kid's got to go to college. I sure wish I had that money back. Well, how do you get it out? How do you access that?
So the cash value could be accessed 2 ways. It could be accessed in the way of a loan or a withdrawal. So in the case of it withdrawing in a loan, the insurance company will charge you a nominal interest rate on the money you borrow from the policy, and it does not need to be paid back, or you could pay it back if you choose. In the event of a death claim on that policy, if the insurer does not pay the loan back, it's deducted off the death benefit.
Off the back end,
that claim.
And just out of curiosity, let's say the interest rate was whatever, 4 or 5, 6%. Does that interest go to the insurance company or go back to your own policy?
Well, I've seen in some of the policies where the interest is paid by the insured, but in some cases, the insurance company will credit the interest rate back to the policy. Wow. In the case of a loan. I've seen that in a bunch of different IUL illustrations.
So you could, access, withdraw a loan like you're mentioning there, you could access your own cash that you've been putting into this for many things, like in this example, college tuition. But maybe if you've got a healthy enough, large enough cash value, you could go, well, I've been always wanting to start that business, or I've been wanting to buy that piece of real estate, or I wanted to buy a vehicle. You can use it for anything. It's just inside this type of a life insurance policy. Right.
As long as you never have to pay the loan back, and as long as it's above your original basis, below your original basis, it's going to be tax free as well.
Okay, now that's huge because you think about the bucket of water with, new water coming in and then all these holes where water flowing out. You want to keep as much of your water or your money in your bucket as possible. Well, what makes water flow out or money flow out? Expenses and taxes. Well, you can't eliminate expenses or taxes, because you're going to have fees in whatever account there's going to be, but you want to keep them as low as possible. And same with taxes. Well, we all know that taxes are not fun and taxes are going to continue and they're probably going to go up. Who knows? But if you can have this kind of growth like you're talking about and it's growing tax-free, that's a pretty big win.
It is, and I've read some case studies where certain people will get multiple policies, whether it's IUL or whole life, and feed these with premiums, and over time draw cash out of these policies, and just for the purpose of cash tax free over time. And it's really pretty cool.
Because if you're at a certain, and we don't need to get into detailed strategy and numbers and all that, but if I'm understanding things correctly, you want to maximize, your retirement accounts as much as possible, and maybe a Roth IRA is a great
Right.
choice. But at some point, you can only put so much in, and if you make a certain amount of money, then there's certain caps. Well, maybe this could be, once you've exhausted that, maybe this could be something now you start rolling, your retirement funds into this kind of a vehicle for all of these benefits we're talking about.
Right. And that's exactly what we do with certain clients. If they are sitting on a large pile of qualified money, and you kind of treat it, like you said, as a Roth conversion, but to insurance.
Yeah. And maybe you don't even, who knows? Everybody's different. Maybe you don't convert a Roth to this, but maybe you just go, okay, I've tapped out everything I put into this account. So now my funds I was putting into this Roth, since I can't do it anymore, I'm going to put it into this. So there's a lot of ways, but I think that the revelation here, the aha, is a lot of people think insurance is term, and they don't understand that you can put money in and you can have tax-free growth and dividend potential and guarantee no losses. It's like, this is kind of like a kid in a candy store when you're thinking about safety and growing money and wealth for retirement.
Right, Mike. And half the challenge sometimes is just getting all the information to the clients, and having to explain to them how a lot of these contracts work without getting into how all the details of the nitty gritty of these contracts, because they can be complicated.
Yep.
And it's to get to have the education to the clients and how these can help them is really is half the battle.
Well, and the other thing is, a lot of times, human nature is, okay, that's cool. I'm just going to go Google it and get that. This is not something you could just go click, set me up with this, and yay, it's done. You need someone that knows how to navigate through all of these options and choices and educate you on this. So I think that's a huge thing for people to keep in mind. It's not some commodity like, oh, I just want to buy a pack of gum, so I'll get it from Amazon rather than Walgreens. This is something where you need to sit down with someone that knows, the pitfalls and the landmines, and that's where you come in to help explain that to people.
Right. There's a lot of factors to take into consideration. Is the person insurable? How old are they? What health class are they going to get? What could we feasibly put into this policy premium wise? Let's look at the tax return. What could we settle on? And all the numbers have to make sense, and so that whatever product of insurance that they're getting into, their savings, their investments, we look at it in a holistic view where everything has to work together. It's very important for us.
And this is not a newfangled, new idea that, has never been proven before. Hasn't this been around for like over 100 years?
Yes.
I think that if I'm remembering correctly, this is something like, what? The banks where we put our money and they give us our little paltry whatever percent that they give us, they're taking their money and putting it into these types of policies. So if the bank is putting our money or their money into this, there's got to be some validity and safety and protection in that. So it's not some new thing. Just because you haven't heard of it before doesn't mean it's new and unproven. It's been around for centuries.
Right. The banks have been doing it, like you said, 100 years. But the thing is our clients are not 100 years old, so we have to.
Yeah, so it's kind of like, remember, I forget who said it. Maybe I've heard it from Jim Rohn, the old teacher from back in the day. But it's been said so many times: success leaves clues. So if you want to be successful, look at the clues that other people have been doing and follow them. Well, if the banks have been putting their money in this kind of a thing for 100 years plus, maybe we should look at it and see what the validity is and see if it would benefit us. Now, should every single person put every single dime they have in this? Of course not.
No.
You have to sit down and say, how would this be a potential portion option for me? So that's where you would come in and like you said, look at, all the factors and see what that would benefit the client. So I think this is just so neat just to hear about some of these benefits, Enrico. So if someone is, curious to go, hey, could this, or how could this benefit me? How could they reach out, connect with you, and maybe have you show them some potential options?
They could visit our website at erc401.com. And all of our contact information is on there. And if you go to our team portion of the website, you can see my contact info. And they can contact us anytime they'd like.
Neat. Well, I really appreciate you coming on, Enrico. It's a real pleasure talking with you today, and I appreciate your time.
Thank you, Mike.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.